Do asset prices no longer make sense? Bitcoin saw price action above $10,000 a coin earlier this week before falling back down below $10,000. And of course, the stock markets continue to rally despite poor economic performance all over the globe. Here to talk about this disconnect and how investors can be reading market signs is Alex Mashinsky, CEO of Celsius Network. Alex, it's a pleasure to have you back on the program. Welcome.
Thanks, David. Great to be here.
We're going to be talking about your Bitcoin price projections later in this interview. But first, let's talk about what is happening around the world. Alex, you said offline that the stock markets are pricing in optimism and that everything is priced in as being good, but it's not good. What do you make of what's going on?
Well, I think that the general, there's too much money in the market, right? The Fed and other sources basically pushed tremendous amount of liquidity into the market. The most risky place to put it in is actually in the bond market because it's almost at zero. So there's much more risk than reward there. So the only place where you can actually put it to work is the stock market. And that's exactly the intent that the Fed had when it created all this liquidity, right? Is to reflate prices, bring back the animal spirits, and calm down all of this volatility. So the Fed is achieving its goal. People who hold assets are achieving their goal, but 40 million Americans are unemployed, and the U.S. economy is definitely not achieving their goal. So that disconnect, it tells you basically that the stock market attached itself to the Fed and to the Fed put, but it detached itself from any kind of gravitational pull that the real world has on real market prices and real stock prices.
Now, offline, we were talking about the situation in America, but in particular in New York. You said that the riots in the streets were the worst you've ever seen. How are you reading this? How does this impact consumer confidence in the economy, you think?
So the saving rate has jumped to, I think, all-time high, which tells you people are not spending. And it's not because people don't want to spend. You can still order anything you want from Amazon. But people are just nervous, and they're worried about their job. They're worried about their family. They're worried about the future. And when you have that kind of contraction of spending, it doesn't matter how many factories you reopen or how much supply you're going to provide, because the demand is just not there. So what I'm worried about is the disconnect between all of us thinking that we're going back to normal and what's actually going to happen when we reopen and we realize that not everything is going back to normal. You cannot run a New York restaurant at 50% occupancy. You cannot run an airline at 50% occupancy. Most businesses around the world do not run at 50% occupancy when they're just borrowed trillions of dollars worth of debt, right? They leverage themselves up and they're assuming they're going to go back to normal, which is not where we're going to. So I'm just really worried about basically what's going to happen to the stock market and what is the Fed going to do in reaction. The Fed is saying we'll do whatever it takes, but the fundamental basically tell you that it doesn't matter how many bazookas you shoot at the problem, you have to deal with the problem itself. And what we need to do is retrain these 40 million people to have new jobs, not to try to get them to get their old job back.
Alex, stock market optimists are saying that the disconnect is the new normal. Fundamentals don't matter because the Federal Reserve and, as we'll mention later, it's the ECB. They're just printing money like no tomorrow. Why do we care that the economy isn't doing well when stocks are just going to go up no matter what?
If you look at the last 20 or 30 year history, since the 1970, basically, when we went off the gold standard, yes, they're right. But if you look at the last 3,000 years of history and you look at all of the empires that minted their currency and then debased it, they all ended up in the history bin of have-beens, right? Empires that have been. The Roman Empire, the Byzantine Empire, the British Empire, the Dutch Empire, they all debased their currencies. So we have a very precious golden goose. It's called the US dollar. That is the source of the power of the US economy. It's not what we make here. We barely make anything in America. We are 70% service economy. So if we're going to continue to draw down on the power of the dollar and think by debasing it and think that nothing is going to happen, we're just fooling ourselves. So my call to the Fed and my call to Treasury is that they need to invest in the future of America, not save the past. And what they're doing right now, most of their actions to date have been to put a blanket or a net under everybody. And the problem is that the net have very large holes in it. And all the little businesses, all the mom and pops who are rioting here on the streets, who are telling you, hey, we're not seeing any of this money, right? They all fall through the net. The net only catches the too big to fail and the people who are credit worthy that the Fed is going to buy their debt, right? And that's the 99% versus the 1%. So you're seeing the anger, you're seeing the frustration, the demonstrations about all of that. Most people don't even understand how the invisible hand is working here, but they know it's not acting in their best interest.
Absolutely. So on Thursday, the ECB has announced that it's going to inject an additional 600 billion euros on top of what's already been given, bringing up the total in the pandemic emergency purchase program to 1.35 trillion euros, which I believe is the highest in the ECB's history. What do you make of this injection of liquidity? Is it saving the past, as you say, or are they investing for the future?
So Europe is definitely a much more sick patient than we are. You can't just resuscitate them and bring them back to normal. The German GDP is negative. After the reset, they did not go back to the same levels that China or other economies went back to. So you're seeing deep recessions in countries like Italy, Germany, and others. You're seeing the UK leaving the EU. All these things are 7 magnitude or 8 magnitude Richter earthquakes. So Europe is going to have major issues. The liquidity may help a little bit, but again, their banks are still in trouble. They never recovered, and again, throwing more money at the problem may kick the can down the road, but it's not going to solve any of the problems.
Okay, let's take a look at Bitcoin now. A lot of investors are interested in the cryptocurrency space given fears of currency debasement in the fiat currencies like the US dollar. What do you make of this week's Bitcoin prices? We saw prices jump up to $10,000 and beyond and then quickly come back down. It's now trading around $9,800 a coin as of Thursday afternoon. What happened this week, Alex?
Yeah, so I think when Trump announced that he's thinking of using the National Guard, that was a sign for hodlers or speculators to buy more Bitcoin because they felt that volatility would get more people into the coin. And immediately after it breached 10,000, we saw short sellers take advantage of that higher price to initiate short position. Celsius Network lends to both sides. We lend coins to the short sellers. We lend dollars to the guys who want to go long, to institutions. And I've tweeted about this several times in the last few months, saying that we are going to kiss $10,000 several times. And even if we break through it, there's another resistance level at 12 and 14,000. For us to make new highs by the end of this year, which I'm still predicting that, we will need to basically break those two support levels with a lot of conviction. Today, there is a very high level of conviction on both sides. The shorts are have a lot of conviction that the price is going down back to the 6,000-7,000 level, and the longs see new highs. So we will see what will happen.
All right, well, let's talk about the new highs that you just mentioned. Bloomberg Crypto Outlook issued a report recently, and I'm just going to quote the report. They said that fast forward 4 years, in the second year after the almost 75% decline in 2018, Bitcoin will approach the record high of about $20,000 this year if it follows the trend of 2016. Alex, do you agree with this view from Bloomberg?
Yeah, I've been tweeting about that since January. Even when Bitcoin was $5,000, I still said new highs by the end of the year. And the reason for that is really structural. Two big events happened. One is the halvening, which basically the supply of new coins has been cut by half, right? Which is a tremendous deflationary pressure on the Bitcoin, right? So the amount of new Bitcoin hitting the market every day has got cut by half. At the same time, what we've seen is dramatic increase in the number of new people signing up, first-time people who open accounts and buying at least one Bitcoin. Right, that number is an all-time record. So when you have increased demand, decreasing supply, yes, there's some noise in the system from the last few months, but all of that is an accumulating effect, meaning that every day that goes by, there's more and more accumulation of demand, and there is a longer period with less supply, which should lead us to new all-time highs.
One thing you'll notice, Alex, is that this year we've noticed a close correlation between Bitcoin prices and equity prices. As equities collapsed in March and saw a V-shaped recovery, so did Bitcoin. Do you expect this correlation to continue throughout the rest of the year?
So there should be a decoupling there.
Yeah.
I mean, if you look at any kind of logic, but because the same people trade stocks and trade Bitcoin, the animal spirits, they behave in the same way. So the problem that the crypto community has is that it does not have enough hodlers and it has too many speculators. So that's why you have very high correlation. As the number of hodlers increases, even though they don't trade as much, so they don't move the price, their overall percentages will overpower any number of speculators. So the market cap of Bitcoin continues to go up, and the percentage of hodlers as an absolute number out of the total volume is increasing every day, and that's what matters. So we're going to see volatility, but the volatility is going to be higher highs and higher lows.
Let's talk about the altcoin market now. We've seen altcoins lag Bitcoin for quite some time now. Do you see a resurgence of a 2017 event for altcoins anytime soon?
So again, the most speculative players in the crypto community are the guys who are betting big chunks of money on altcoins, right? And it's worked pretty well until now. We went through almost a 2 year of crypto winter, especially for altcoins. So there were a lot of assets that were depressed compared to their intrinsic value. I think Ethereum, for example, was underpriced at 80 or 90 or $100. So it's now trading at about 240. And the hundreds of projects that are running on Ethereum basically usually run with the price of Ethereum. So if you peg those two together, you'll see there's a very high correlation between the altcoin prices and the ETH prices, because a lot of the on-ramps and off-ramps are priced in ETH. So all the limit orders are priced in ETH. So when ETH goes up 100%, the alts go up 100% as well. So, but I still think there are too many players there. I think we still need to kind of separate the wheat from the chaff and pick the 4 or 5 winners that are really going to be the ones who build the next chapter of the crypto world. And we still don't know who they are, right? We're looking at a lot of great projects, but it's not clear who's going to be the winners.
Jumping ahead now, you mentioned that it may not be clear who the winners are, but do you ever see a potential for Bitcoin to be dethroned as the largest cryptocurrency by an altcoin? Is that possible?
So it's not a popular view. I've said this several times. I said that I think the winning blockchain has not been invented yet. So for now, Bitcoin is king, and I'm a Bitcoin maximalist. I think Bitcoin will always have that store of value, unique place on the blockchain. But the use cases, we need more use cases, right? And when you're seeing the government of China or the US dollar kind of competing for the digital version, and there is a room for a new creation, for something new that is better than Bitcoin, that can compete as the open source or the open ledger alternative to these government mandated solutions, or Libra as a corporate mandated solution. So these are the 3 horses that are effectively running against each other, with the winner, in my view, being something new that can also function as a form of payment, fulfilling the global needs of citizens with limited supplies. Because the problem with the digital dollar or with the digital yuan is that neither one of those are going to come with limited supplies, which means it doesn't matter that they run on a blockchain. They do not represent scarcity. They do not solve the problem of what the Fed and Treasury are doing every day by printing more dollars in 90 days than in the last 100 years put together.
Finally, Alex, let's look at gold now. Offline, you said that gold is not doing what it's supposed to be doing. What do you mean by that?
So first, gold went down when this whole panic started instead of going up because there were liquidations and people needed dollars. So they were selling gold. So it behaved in the opposite way that it was supposed to. Then gold started going up with the market going up, but then it plateaued. It kind of basically people realized that maybe the Fed blanket or the Fed net is almighty. And putting too many dollars in gold represents a miss, right? You're missing. You could have put those dollars in the stock market and you would have been up 30, 40, 50%, sometimes 100%, depending what stock you invested in, compared to gold. So I think gold is kind of losing its luster. It's hovering at a certain level here. And again, compared to in dollar terms, right, the gold is actually depreciating because we're printing many, many more dollars. So if you do gold versus the stocks, these stocks, the winners that Wall Street picked, gold prices are actually going way down. So it's not doing what it's supposed to do when the VIX is in their 30s, 40s, or 50s. It's not doing what it's supposed to do when people want non-correlated assets. And it just tells you the power that people have in their head about the Fed, right? I don't believe in that power, but people believe that the Fed is almighty.
Can you see gold doing what it's supposed to be doing later this year?
I think what's going to happen is that the fiat dominoes of many, many countries, fiat currencies toppling, right? Like we're seeing in Venezuela and Lebanon and Turkey and Argentina and so on. You're going to have many, many more countries like this topple. And all those countries are going to have to default on their dollar-denominated debt, like Brazil, for example. They're just not going to be able to pay their debts, right? And all of that is going to come back to roost to U.S. and European banks. And there's not enough money. Even the Fed cannot print that much money to take $100 trillion worth of debt and basically recycle it, right? Or kick it down the road. So that when you have that kind of systemic debt problem, even then, that's when everybody's going to be looking for the exit, selling all their dollar-denominated assets and trying to buy the few non-dollar-denominated assets like gold, silver, or Bitcoin, right? So that moment will come. It just not happen to be now. And again, if you look at the charts from the Great Depression, from the 20s and the 30s, you will see there was a 50% recovery, and everybody thought everything was great. But we haven't solved anything, right? The patient is still sick. The patient still has over 30 trillion in debt, right? The most debt that any country ever owed anybody else, right? The United States of America, and over $120 trillion worth of unfunded liabilities, which are now increasing because less money is coming in, and we have to pay for all these people who are unemployed and the health issues and so on. So again, I don't want to sound pessimistic. My main point is not that we shouldn't do anything. My main point is that we should take these precious dollars that we're printing and invest them in rebuilding our infrastructure, bringing back the supply chain to the United States.
Sure.
All that stuff instead of bailing out failing companies and zombie companies.
Great thoughts today, Alex. Thank you very much for being back with us today.
Thanks for having me.
Alex Mashinsky, CEO of Celsius Network, joins us, and I'm David Lin of Kitco News. Thank you for watching. Stay tuned.